For more on today's trade, Chris Conway joins us now from the Australian Stock Report live out of Melbourne. Chris, good afternoon to you. Gains for markets today, 0.7% stronger. What are you putting it down to? It really is the materials space today.
Good afternoon, Ingrid. Yes, it seems to be the material space, and somewhat of a surprise as well after we saw iron ore down overnight. So, yeah, I really don't have a great answer for you. I think there was a bit of misread from what happened yesterday afternoon. Obviously, we had that 100-point turnaround yesterday afternoon. There weren't great leads, I don't think, from the overnight session, so probably a little bit of a catch-up. You know, someone obviously got it wrong yesterday, selling ahead of the Fed locally, clearly got it wrong, and are playing catch-up this morning. So it might be a bit of that.
You say, though, the ASX 200 is getting a bit overcooked at this level, around 5,300. Why do you think that?
Look, I think it's overcooked based on previous price history and the lack of catalysts moving forward. So we all know out there in Traderland that 5,300 was the cap in the last quarter of last year. Without catalysts, I can't see, you know, that area being breached to the upside. I think commodities are a little bit overbought. A little bit overcooked as well. You know, we do have a potential catalyst in the RBA decision next Tuesday. It's now a live event. A lot of people believe. I'm not quite in that camp. I don't think the RBA is going to do anything. It is one data print. The RBA and all central banks recently have shown that they're not reactionary. You know, like I said, it is one data point. So I don't think the RBA is going to be too keen on just coming out a week after that data point and cutting rates further. And again, they've said as well that they're concerned about the impact that a further rate cut might even have. You know, it's an economy of lesser returns.
I think the argument is, though, it's just such a big miss on expectations, and that inflation read's only out every 3 months. So if they have to downgrade their forecast for inflation in the Statement of Monetary Policy, there is talk that they will, in fact, have to cut rates. They'll be forced into cutting rates on Tuesday. Now, I guess the question is, if they do cut rates against what you think they will do, but if they do cut rates on Tuesday, just how far is the upside for the ASX, do you think?
Look, that's a really good question. I guess the next sort of technical levels are up around 5,400, 5,450. So from a technical standpoint, probably only another 150 points, which is what, you know, less than 3%. But if the banks get going, and of course they could as everyone hunts for yield, then, you know, that would really drive the market higher. So there is the potential for it to go higher, you know, on the back of that RBA cut if it comes. As I said, I don't think it will.
In terms of specific brands, we're talking about it in a bit more detail in about 15 minutes' time, but I'll just get your quick view on it because, of course, a big deal for that one, a $1.1 billion takeover by that US company Hanes brand, and, of course, seeing Pac Brands up 23% off the back of this at $1.15, which I believe, in terms of where the price, the $1.1 billion bid is, it's at right on, or basically right on where that price is, right on the not really, it's a very slight premium to where the price is offered.
Yeah, I think the offer price was $1.15, and if you're telling me now, Ingrid, that it's trading at $1.15, well, it's right on the button. So, you know, I wrote in my note to clients this morning that I don't see why the deal wouldn't get done. And if it's trading at $1.15, well, that's the market telling you that they don't see any reason why the deal wouldn't get done. Of course, if there was a risk premium built in there, it might be trading down at $1.10. You know, with some speculation that the deal won't get across the line. But the board has approved it. It seems like a pretty juicy offer. I don't know this for fact, but I'm pretty sure Hanes have said that it will be the last offer and they've got until Monday to accept it. So it seems like it gets across the line and the deal gets done.
Okay, I also want to talk Spark New Zealand because this is one that you're looking at buying at the moment. Just interested in why. It's up 1.5% today. What's the attractiveness of this stock?
Yeah, so look, we like the growth profile of Spark. You know, obviously, you know, if you're going to compare it with another business, it's very similar to Telstra. But since they changed over from telecom, they really have broadened their offering, and they have gone out of their way to attract more customers, but also different customers. So, in terms of the growth profile of the company, we think some of those areas that they've broadened into, I should say, have better growth potential than say a Telstra, which is a much more mature business. They've got pretty good growth in their IT services business. They are still getting growth in mobile, which you know, in New Zealand is as competitive a market as it is here in Australia. And I think that's why you see the Spark chart sort of top right and the Telstra chart bottom right, is because there's more potential growth in Spark than say a Telstra. So we like it. We like the story. and we've had a cheeky little trade on it this morning.
Okay, finally on commodity prices, just want to talk about this for a minute because obviously we are seeing, and you mentioned before, iron ore players today soaring ahead. Fortescue up 7%, as I mentioned, BHP up over 4%, despite prices sort of not rallying anymore. We did see that short-term rally in the iron ore price. What do you see going forward, though, for oil and iron ore? They've obviously seen this little rally, but do you think that's it for them? Do you think there's downside from here on?
Really good question, and I think we have to split out the two. So the basic premise, or the starting premise I always think about in terms of commodities, is that commodity markets and commodity plays, equities, they tend to overshoot. We saw oil and iron ore overshoot to the downside when they were getting absolutely crushed. I think now they've overshot to the upside. Iron ore probably more than oil because of all the speculative trading that's going on in China. The fact that we have just had a restock in China as well. So there's a few factors there that are likely to wane, and I think iron ore was already coming off. Traded at 70 late last week. It was trading at 60 towards 60 overnight. So I don't think that's sustainable. I don't think the gains in iron ore are sustainable at all because there's been no shift in the fundamental supply and demand, or more specifically the supply side dynamics. Oil's a little bit different. I think that rally is potentially more sustainable because a lot of US production, as reflected in the numbers overnight that showed production falling, a lot of US production that is marginal has gone offline. So there are shifting supply side dynamics in that oil market. Now, they might take until early next year at best for that market to come back into full equilibrium. But there's at least something happening on that supply side. So I think oil can continue to rally. I think a logical place that it will sort of stall, though, is when it gets up towards the $50 per barrel handle.
All right, Chris Conway, always appreciate your time. Thanks so much for joining us.
Thanks, Ingrid.
Chris Conway there from Australian Stock Report, joining us live out of Melbourne.